Friends, welcome to our today's session. Let us continue our discussion on cost of equity. Last few sessions, we have been discussing about cost of capital, and within that, we have already completed our discussion on cost of debt, and some part of cost of equity also we had covered. Right. And by this time, what we have understood when we talking about cost of capital, we refer to the expectation of the investor or the expectation of the lender. Let us say someone has given you a debt or loan, what he is expecting. We should know that. The expectation of the investor, expectation of the lender becomes cost for the business. For example, if the lender is expecting 15% interest, so that is the cost of debt. And an equity holders, let us say he is expecting a return of 20%. The 20% becomes cost of equity. So on that concept, we have learned how to compute cost of debt first. We have seen that cost of debt is a very simple thing. We have to see how much interest is paid per annum. And if there is some other cost which is associated with the debt, what is the per annum cost divided by what is the average debt fund deployed. On that basis, we'll be able to compute cost of debt. Right. And we have understood if you can compute IRR, then you can get the most accurate cost of debt. And there are two things. One is pre-tax cost of debt, another is post-tax cost of debt. When you take a debt and you pay interest on it, there will be a saving in income tax. The saving arises because when you pay interest, interest is claimed as an expenditure, and expenditure reduces profit. And since profit gets reduced, you pay less amount of tax. So debt involves a kind of tax saving, which is called as tax shield. Therefore, in case of debt, we calculate two types of cost of debt. One is pre-tax, second is post-tax, or before tax or after tax cost of debt. We have also understood one more concept, that cost of debt is cheaper than cost of equity. Equity is more costly for the reason that, first of all, equity shareholder takes more risk. Second reason is that debt has got a tax shield. Because of these two things, cost of debt is cheaper, and cost of equity is little costlier. Now, in the previous sessions, I was showing you this chart where we have seen that various methods or various approaches of computation of cost of equity. Right. So we were discussing about this thing, dividend valuation model, in no growth situation and in growth situation. So many models are there. All of them may not be relevant for you, keeping in mind your syllabus. So these important approaches I'll be discussing. First, friends, we have already discussed that if there is no growth in dividend, that means if a dividend is constant, dividend on year basis, if you compare their say, then the formula for cost of equity is very simple. The what is KE? If you read it, you can understand KE means. Can you read it, the formula? What is KE? Can you read it out? Here KE is equal to D1 by P0. D1 stands for dividend which is expected next year. One means after 1 year. P0 means price today. So when growth is not there, KE is equal to D1 by P0. And when growth is there, then the formula is, we'll slide, and we have done some example also the last session. And when there is growth in dividend, the formula gets modified like this, D1 by P0 plus G. Okay. So we had also solved some questions using these two formulas last two classes. We have been doing that. Okay. Now, one more thing is that in this context, when we are learning cost of equity, there is also a need to compute this growth rate. And if you look at your screen, you can find out there are three methods of computation of growth rate. One is simple average past growth rate. Second, point-to-point movement in dividend. Third one is G is equal to P into R. Okay, this is one example we had done in your previous class. It says if the growth rate in the past 3 years was 10%, 12%, 7%, then what is the growth rate? Here, by applying simple average past growth rate model, we can find out, we'll be calculating the simple average of this past growth rates. So 10 plus 12 plus 17 all divided by 3, it comes to 13%. So 13% is the simple average past growth rate, which can be taken as the growth rate of that business. Hope you have understood this. Are you getting me? We had already discussed this thing in the previous session. You can refer to recorded videos also. Now, second method you see, computation of growth rate by applying the second method. Here it talks about the point-to-point movement in dividend. You'll be understanding it if you read this example and try to appreciate the situation. The example says dividend 5 years ago was 10 and today it is 20. Last class I had explained you. This 10 has become 20. That does not mean 100% growth in 5 years. That means yearly 20%. We should not be computing like this. We have to understand that what is 20 today? 10 years back it was 10. That means you go to, let us say, 5 years back. 5 years back it was 10. At that point, if you see, the present value of that money was 10 and the future value was 20. Okay, present value was 10, future value was 10, 20. And you have been circulated some present value, future value tables, right? So present value multiplied with future value factor is equal to future value. I repeat, present value multiplied with future value factor is equal to future value. So what is this future value factor? Future value factor is the future value divided by present value. Is it not? Is it not? Okay. And in future, you are getting 20 rupees if you are investing 10 rupees today. So it comes to 2.000. Now we can refer to future value factor and try to find out the same number in the factor in 5 years row. If you find, you can find out that amount corresponds to 15%. I had shown you in the previous session. Again, I am trying to show you again. So for that thing, I have to take you to the future value factor table. Just give me a moment. I am again sharing you this future value factor table. Now look at here, sharing the screen. I'm opening for you the future value factor table. And I told you it's for 5 years duration. So period is 5 years. I'm selecting this particular row. I am looking for the figure 2.00, which is close to 2.011. This corresponds to 15%. So that means what? That means 15% is the growth rate. And this is my future value factor. For this future value factor for 5 years, growth rate is 15%. Okay, so on that basis, we have computed growth rate is 15%. I hope you have understood this. Are you getting me? I hope you have understood. Next method. Next method is talking about that growth is equal to B into R, where B stands for retention ratio, R stands for return on equity. Retention means the money which is retained in the business. That means which is not paid as dividend. Okay, for example, suppose you are earning 100 and if you are paying dividend 40 rupees, that means 60% is your retains. You are retaining 50%, 40%. Let us say you are saying I am retaining 20%. That means 80% is your payout. Here is an example. Capital is 100 lakhs. Return on equity is 20%. Payout ratio is 60%. When I say payout ratio is 60%, that means retention is 40%. So by applying this formula, last class I had shown you, by applying this formula, you can compute what is the growth rate. So 40% into 20%. So it becomes to 40% and 20% becomes 8% is the growth rate. Hope you have understood this. I had explained it in detail by uh, referring to this table in your last class. Here is one more example. This also we had solved. Dividend per share is expected to be rupee 1 next year. Growth is 6% per annum perpetually. Market value is 25. Calculate cost of it. First of all, what you have to do, you know, KE is equal to D1 by P0 plus G. So D1 is 1. P0 is 25. Growth rate is 6%, which is 0.06. It comes to KE is equal to 10%. Here is one more example. Read this, you'll be able to understand. Expected future rate of growth in dividend is negative 5%. Today it is 10%. Current market price is rupees 50. Calculate cost of equity. This also we had done in our last class. Again, I am repeating for your benefit. If you see, what is D1? Since growth is negative, today's dividend is 10 rupees. In future, it will be less by 5%. So it becomes 9.5. So D1 is 9.5 divided by P0 is 50. And growth rate and plus G, you know the formula is D1 by P0 plus G. Plus G means your growth is negative. That means plus minus 5%. That becomes minus 0.05. So 14% is the answer. After this, we had done it. Then let us see the next formula. Very simple formula. Here also you can do it. Here KE is equal to earning per share divided by net proceeds or market price per share. Okay. So if this data is available, earning per share divided by net proceeds or market price per share, you'll be able to compute. Okay. Here you can refer to one more example. A farm considering an expenditure of rupees 60 lakh for expanding its operation. Informations are as follows. Number of existing equity shares are 10 lakhs. Market value of existing shares is rupees 60. Net earning is 90 lakh. Read the question. Try to understand. Compute the cost of existing equity share capital and of new equity capital, assuming that new shares will be issued at a price of 52% and cost of new issue will be rupees 2%. Read this question. I'm giving you 2 minutes to read this question. Little complex. It may appear to be little complex, but as we solve, you can find it very, very easy. I repeat, farm needs to incur an expenditure of 60 lakh. Now, how many shares are there? 10 lakhs. Market value of existing share is rupees 60. Net earning is 90 lakh. Compute cost of equity, share capital and new equity, assuming that new shares will be issued at a price of 52% and cost of new issue will be rupees 2%. Let us try to solve. But you know the formula I was showing you, earning per share divided by net proceeds or market price per share. Let us calculate first of all earning per share. We know total earning is how much? If you read the question, it says earning is 90 lakh, number of shares is 10 lakh. So earning per share is equal to 90 lakh by 10 lakh is rupees 9. Okay. And you know the formula. What is the formula? Earning per share divided by net proceeds or market price per share. Market price per share, it is saying 60 rupees. So you can calculate KE is equal to 9 by 60 into 100 is equal to 100 is just to convert it into percentage. It comes to 15%. Okay. Or you can use the other formula also. That is net proceeds per share. What is net proceeds? If new issue will be there, it will be issue price will be 52, but there will be a cost of 2 rupees. So net proceed is how much? 52 minus 2, 50 rupees. So KE is equal to 9, that is earning per share divided by 52 minus 2 into 100 is equal to 18%. There are two ways of solving the question. One way, and answers will be different in both the cases because approaches are different. So one case is KE is 15%, second case KE is 18%. So question may appear to be a little difficult, but you have seen it is very easy to come. Okay. After this, have you understood? Now quickly, one more approach we'll see. This is called as the realized yield method. Realized yield. So if question has given you the data, what is actual yield? Dividend means what is distributed. Yield means it may not have distributed. If it is earned, it is earned. Okay. So if that data is given, then formula is almost same. Only thing you have to take, what is the actual yield per share divided by market price per share. You'll be able to compute cost of equity by using this method. But this data should be available. What is the actual yield? If total yield is given, total yield divided by number of shares, you can get actual yield per share divided by market price per share into 100 to make it a percentage. So you will be able to arrive at cost of equity by using this formula. So three things we have already learned, or three methods. You see this, if we go back to this chart, you can see dividend valuation model, earning price approach, realized yield approach we've covered. Now next is capital asset pricing model or CAPM. CAPM model we are going to learn today. I'm showing you how we are going to learn. And we'll go for a small break. Okay, now this is the model we are going to learn now. Let us take a quick break and just for 5 minutes, please join in 5 minutes. We'll be learning CAPM model. Thank you.